Hello, ladies and gentlemen, and thank you for joining me. I'm here today to talk to Duncan MacInnes, who's the manager of the Ruffer investment company. That's ticker RICA that trades on the London Stock Exchange. Hello, Duncan.
Hi, Charlie. Thanks for having me.
So we can do a little review, a little chat about your company, what your views are, and how things are going. And then we're going to open up to questions at the end. So please put your questions in as we go through, and we'll cover them later on. Firstly, Duncan, tell us about Ruffer. Who are they? Where did it come from?
Yeah, well, I know you know Ruffer well, and I'm sure many of your subscribers do too. Ruffer only does one thing as a house, and that's global multi-asset, go anywhere, absolute return approach. The whole firm has about £26 billion under management, and Ruffer Investment Company follows that exact same investment strategy and is about 1 billion market cap and has been listed since 2004.
Fabulous. So where's the firm? How many people? How does the investment office work, and so forth?
So the firm is mostly based in London. We've got a small office in Edinburgh of 9 people, which I'm one. We've just opened a New York office, and we've also got a Paris office. But really, most of the firm and the investment engine is in London. The investment decision making was originally done by Jonathan Ruffer, our founder, still around, still chairs our Monday morning meeting. But over the years, we've sort of broadened that out. We have 2 co-chief investment officers supported by a research team and senior portfolio managers like myself. I mean, probably we should mention the returns. We're really all about not losing money. But that's not sufficiently ambitious. So over the long term, we've delivered about 8.5% per annum after fees to our clients. But that's good. It's ahead of the equity market. But the key is doing that with very limited drawdowns. So the max peak to trough loss you could ever have experienced with us is less than 10%. And we'll probably come on to that as that's pertinent to the current environment. But it's capital preservation and over the longer term trying to deliver equity-like returns.
Fabulous. Okay, let's dive in now. We've got the background. So the current asset allocation, as a firm, you kind of philosophically split your assets between what I think it used to be called fear and greed, but what I can see here in your annual report is growth and protection, as you call it. And in a nutshell, equities 14%, very low. Commodities and gold 13, not bad. That's pretty punchy. Cash 5, inflation linked, index linked 19, short dated, which is basically cash 34%, and then protection, which we'll come on to later, 15%. I mean, that's a really, really defensive portfolio with an outlier in inflation protection, commodities, gold, index linked.
Yeah, that's right. So we do always have this balance of protection. Growth assets. Right now, we have as little in the way of growth assets as we've ever had in the history of the firm. That's one of the benefits of being totally unbenchmarked is that you can start with a blank sheet of paper and build the portfolio that you want to have rather than that you're forced to have by some sort of arbitrary rules. Yeah, so we've got 15% in equities right now, which tells you that we're pretty bearish. And then on top of that, we've got that significant allocation to commodities, which we can talk about in more detail. But really, why are we so defensively positioned? We can definitely dig into all this, but we think the market still looks expensive and fragile. We think we're on the cusp of a recession, and we think that the risk premiums for moving further out the risk curve from sort of cash are very, very low by historical standards. So you're not really being paid to take risk. So why should you?
So you take the view that that although clearly there are pockets of value in the world which you own, on average, equity valuations are high, and you can get a really good deal from doing very little these days.
Yes.
And that concerns you.
So the US, the famous phrase, what the US sneezes and the rest of the world catches a cold. The US has been so dominant now that it's 65% or thereabouts of global indexes. So yes, I think there are pockets of value elsewhere in the UK and Japan, for example. But if you look at the US, the S&P trades on 20 times earnings, which is a 5% earnings yield, and the Fed funds rate is 5.25. So that's a very crude way of looking at it, but the equity risk premium therefore would be 0 or sort of slightly negative. You're just not being paid to take those risks.
Fine. Okay, recent performance over the last year, and this is slightly different to your annual report because this is to this morning. Your net asset value of RICA is down 8%, and the share price is down 10. The share price was down 60, but we've seen a wonderful rally in July, so that's really got rid of much of that problem. And then so that's year to date, yeah, down 8 now, down 10 price, and then over the last year, much better, down 2 NAV and down 5 price, or down 4 price. So what's happened? I mean, you talk about Ruffer doesn't lose money, we protect capital, and yet you have when the stock market's up. I mean, that's kind of strange to someone new to this space.
Yeah, so first and foremost, probably apologise to anyone that is a shareholder. We have undoubtedly failed to meet our investment objectives of not losing money this year. The share price experience has been exacerbated slightly by moving from a premium to a discount, but the NAV returns, like you say, I think to today we're down about 6 year to date, and for the year to 12 months -2. So what's driven that? We came into 2023 pretty bearish, worried about this idea of investor portfolios being liquidated, liquidity drying up around markets, and the risks of recession. And I think they were all entirely justified at the start of the year. They have been wrong. Let's not hide from that. They have been wrong, but they were justified, and I think they're just as justified or justifiable today. Where we erred was in the expression of those bearish views. So you could have hidden in cash, and if you'd hidden in cash, you'd have earned 4% rates at the start of the year. So you'd be up to so far this year. Although actually, if you don't gilts, you'd be flat, because the bond yields have gone up and the bond prices have gone down. But we had about 40% of the portfolio in cash and cash-like instruments, earning that relatively attractive yield. But with the balance of the portfolio, we were trying to achieve that mix of protection and growth assets you mentioned. The protection assets hurt us. So most specifically, currencies. We had a big weighting to the yen. We can come back to talk about that, the yen has been weak and the pound has been very strong. So you've been sort of hit with a double whammy there, which has been very painful. What we call our unconventional protective assets. So these are things like equity put options, credit protections, volatility call options. These have been the thing that have driven all of our very good performance through 2019, 20, 21, and 22. They have been surplus to requirements. You don't need protections if the market's rising. So we lost money there. That's sort of to be expected. The killer, the sucker punch, is that the growth side of the portfolio hasn't worked for us. So you mentioned we've got a low equity weighting. It would have been helpful to have had more. But even within the equity weighting, as most people probably know, the market's been incredibly narrow and concentrated year to date, and we just haven't had enough in those big 7 tech companies that have driven markets hard. We had a little bit of Meta, we had a little bit of Amazon, but just nowhere near enough. So the equities didn't work. And then worse, we took a little bit at the start of the year and took some of our equities down and replaced it with commodities, thinking if the economy and markets are going to stay, the show stay on the road, you will need fiscal stimulus in China, probably quite commodity intensive, so commodities will benefit. In fact, equities are up, commodities are down. It looks to us like commodities have priced in a recession and equities are saying soft landing or no landing. So pretty painful year to date, but thankfully, so far in July, things look to be improving from our perspective.
Yeah. So I think that to summarize that, the equity book you've got was kind of sort of global value and very much inflation sensitive on top of commodities as a risk instead of the FANGs and so forth. And it's a funny old year. I'll give you that. That's for sure. But you guys have still very much got the inflation trade on, and what we're seeing is a sort of markets pricing in a return to the Goldilocks scenario. This sort of bonds back to normal, 2% inflation targets within reach. I mean, is this a joke or is this realistic? But this is what sort of markets are kind of telling us. And if that's right, then your portfolio really is radically different.
Yeah. So, I mean, it's a funny old year. It's a sort of throwaway comment, but it's been a remarkable year. So if we go back to 31st December and I said to you, interest rates would hit 5% and in the first quarter, you'd lose 3 of the top 30 US banks, and Credit Suisse all effectively disappeared overnight due to deposit flight. Do you think stocks are going to be up or down? And you certainly wouldn't have thought that the NASDAQ would have its best first half, I think, in history, or certainly in 30 odd years. So it really has been a remarkable year so far. In terms of the inflationary journey, we're known as an inflation house, that we're very worried about long-term inflation being higher than in the past. And let's not be too dramatic about this. We're not saying 10% inflation forever. What we're saying is we think the coming decade will have, on average, 3 or 4% inflation, rather than the previous decade, which had 2% inflation on average. But well, first of all, that's not priced remotely into markets when you look at inflation expectations. So that really doesn't sound like a big change, but that is a profound change. And secondly, the other part that doesn't get enough attention is that we're very worried about inflation volatility. And we've written a lot about this over the last couple of years. So it's not just that inflation is going to be higher, it's that you're going to have a huge amount of uncertainty and choppiness in the inflation experience. So 10% inflation last year, inflation collapsing this year. If we head into recession, you might get some very low inflation numbers. But we do think that you get a policy response to that, which will reinvigorate the inflationary pressures. And so you get this very choppy stop-start experience. And that is a completely different environment to the one of the last 30 or 40 years, requires a totally different level of activity in portfolios and totally different approach to portfolio construction.
So I think that, in summary, the Ruffer Investment Trust is ready for the 1970s, and they haven't quite come to be yet. And I'm certainly sort of asking the question of where inflation lands. But there's a couple more things on your portfolio. So looking at the attribution.
Can I just say on the 1970s? So people think about the 1970s. When you just say the 1970s, people think about high average inflation. Now, there was high average inflation. We don't think we're going back to those same heights, but higher inflation. But what everyone forgets is that there were 3 large waves of inflation, and that's that inflation volatility dynamic.
And the GMO paper on that by Jeremy Grantham's team was that the inflation volatility leads to lower valuations in stock markets.
Yeah, because there's more uncertainty. Yeah, uncertainty up, lower valuations.
Fine. So on the attribution, you made a bit of money from equities, a bit of money from nominal bonds, a little bit of money from gold and gold equities, lost a bit from commodities and inflation-linked bonds, but not much. But then, the elephant in the room is foreign currency exposure. So we'll talk about the yen specifically, which is down to, you've lost 2.7% of the weight has come from that, of the downward pull on the fund. But the biggest has been protection strategies, which I want to come to afterwards. So you've got 16% of the foreign exposure, as far as I can see, is 16% Japanese yen, 10% US dollars, 3% Australia. I think the only one worth talking about there is probably the yen. So why you got, and by disclosure, I've been on that trade too in ByteTree, and obviously, what you're going to say is it's going to go through the roof when the market crashes. But
that's exactly right. What we're going to say. But it's not even just that. I think there's a few legs to this. So if you think back to the financial crisis, the yen rose by 48% against sterling, because sterling went down in the financial crisis because we're very financially sensitive economy. So the yen has historically worked as a safe haven. It tends to go up in crises. So that's a very nice attribute for it to have. But that's not why we've got 16% in it. There's other elements. Firstly, it's incredibly cheap by historical standards. So you look at the sort of Big Mac index, your purchasing power parity, real effective exchange rate analysis, all this sort of stuff, which usually works on a long-term view, but doesn't necessarily work on a short-term view. Hotel rooms in Tokyo are the same price as they were 20 years ago. Certainly not the same in London, New York, Paris, or Geneva. So the currency is undoubtedly cheap. But you also have a catalyst, and that's what's really interesting, in that for the last few years, you've had monetary policy divergence. The rest of the world has been tightening. Japan has been continuing to loosen because they have this yield curve control policy. So everyone's tightening and they're still doing QE. Now, we believe that yield curve control is coming to an end. We've got a new Bank of Japan governor in place who isn't particularly fond of the policy. And if they do that, if the NYCC, which we think is basically inevitable, the only debate is timing, what you will experience is that the bond yields shoot up, and the currency goes up with it. So Japanese bonds go down, Japanese yen goes up, and we hope to benefit twofold. First, from having a significant weighting in the Japanese yen. We also have some yen call options, so we'll get some extra juice from that. And we lastly have something called the Japanese payer swaptions. So these are options that rise in value if Japanese interest rates go up.
So if something happens in Japanese macro, then you guys are going to benefit heavily from that.
That is the plan. Yeah.
You've got 10% in dollars. I mean, so what? But 3% in Australian dollars, not much, but why?
Yeah, so that's down a little bit from 6 months or a year ago. The Aussie dollar is sort of another a cowardly way of playing commodities, isn't it? So it's a cowardly risk asset. So should benefit from fiscal stimulus, should benefit from global GDP, from capex, and yeah, that's why we have that position. But it's smaller than it was.
So you're saying that the Australian dollar is a proxy for commodity prices to some extent, like Canadian dollar, but the British pound is a proxy for bull markets, is it not?
Well, it's certainly
going up, and we're all complaining about it. But is that not telling us that there's a bull market? And should we be questioning, this thesis that the world's so terrible?
Should we be questioning the thesis that
the world's so terrible? It's all going to crash, and the pound is telling you that that's what happens in bull markets.
So sterling has rallied 30% from the Trust Quarteng low, which is just remarkable. A huge rally for a big currency. You could say that the Trust Quarteng low was sort of a bit of a nonsense price. I began my career, cable was at 2. And then it got as low as 1.01, I think, in Q3, Q4 last year. So sterling had already halved versus the dollar, and it's now reclaimed a little bit of that. So I think that the rally in sterling is more about stepping back from the precipice and the removal of a sort of panic from the market, rather than sending you a sort of broader signal. But yeah, you're right that sterling increasingly sort of behaves like a risk on, dare I say it, EM currency.
So you've got this, So we think we've got value on our side with the Japanese yen, but then the biggest detriment to performance has come from protection strategies, which have cost the trust this year 4.3%. Yeah. What's going on there?
Yeah, so just to remind people, this is the portfolio that we have built an expertise in. It's harder to say that we've built an expertise in something that's lost money this year, but we've been building this expertise for a decade or so, and it absolutely saved the portfolio and differentiated Ruffer from many of the competitors through the COVID crash, through owning Bitcoin in 2020, 21, and then through 2022, where most conventional assets fell. So this has been a very valuable part of the portfolio, but it has really hurt us this year. What's in it? It is a mix of various different, what we call unconventional protections. So we've lost money this year in equity put options, not surprising when equity markets have rallied. We have lost money in what we call credit protections. So these are various different expressions of being short high yield or investment grade bonds, betting that borrowing costs or corporate borrowing spreads will widen. And then we have re-engaged recently for the first time in 3 years with volatility call options. And these were very useful for us in the COVID crash, but we haven't used them since. So these are bets that market volatility will rise, because despite all of the uncertainty, all this stuff we're talking about, the VIX, the fear index, is back where it was pre-COVID. Like nothing ever happened.
But the price of volatility is extremely low, and there are lots of these big outliers, like market S&P 500 correlation is at a 20-year low or something. Yeah. All of these things are alarming. Yeah. Yet nothing ever seems to happen. And certainly when I look at my world M2 money supply chart, it's just about to make a new high. So we might see falling money supply in the States, but elsewhere they're printing, in China and Japan, as you mentioned, and these sorts of places. In aggregate, the money's coming back in. And it does seem that these relationships between things like money supply and stock markets become, which were ridiculed 20 years ago. Now they're just so clear that the money supply props up asset prices. And so we don't have a crisis because there's more money than assets.
Yeah, I think, well, firstly, broadly, that's one of the reasons why we're worried about long-term inflation. The shorter term answer, I guess I would say that's something that we got wrong this year, that we thought that the global monetary tightening that we saw in 2022 would continue into 2023. And for various different reasons, like China's reopening, like the Bank of Japan, not just not ending YCC, but actually doubling down on it, you did see more of a global liquidity impulse, even as the US continued to tighten. But we think they are relatively temporary. And ultimately, I think we're probably in the same camp here. Because I think governments and central banks are addicted to low rates, money printing, stimulus, intervention, etc., etc. But we think that to sort of get to that end game, you go via at least one more crisis. So as of right now, the rhetoric and to some most extent the actions as well of central banks are that they are serious about tightening, removing liquidity, trying to get inflation back to 2, regardless of the cost. They're pretty open about being willing to accept a recession. Obviously, they'd like to avoid one, but they will take a recession if it fixes inflation. Our view would be that that's a little bit like sort of talking about going on a diet. It's very easy to talk about going on a diet, but once you actually have to sort of give up food and get up early to go to the gym and whatever, it's quite hard. So once you get into that nitty-gritty of the recession, which we think is pretty soon, and clearly we're starting to feel pain on Main Street with things like energy bills and mortgages and consumer debt and so on. Once you start to feel the bite of that, then that's when they turn the taps back on. But I think you need to go via that moment of acute pain, which is a recession, which is probably accompanied by a market crisis, much lower prices. That's when they turn the taps back on, and that's when you want to get long all that stuff.
Sure. So basically, rates are very high. There's complacency in the air, and we've got visible signs of problems in areas like real estate that presumably spreads. I've been very confused by seeing things like the cash rate remarkably close to the rate of to the yield on high yield bonds, for example. And there's some very strange things going on. But look, can I ask people to start putting in your questions, because I will throw it over to you now. I've got a couple here to go through, and then hopefully some interesting stuff will come through. So I've just had this one, and you've kind of half answered it, but let's just go through it anyway. In the view of very high level of protection and understanding sought from the various hedging strategies that you embrace for catastrophe risk and so forth. But what you get all this protection, but then what about the counterparty risk or bank failure? So if you have some awful event, would you actually get paid basically from all this stuff?
It's a valid question, and a relevant one, because Credit Suisse recently disappeared. So maybe it will give shareholders some comfort to know that Credit Suisse was never on our sort of derivatives panel. Was not never on. We removed them a few years ago because of these exact worries. We tend to sort of exchange collateral on a very regular, almost daily basis. So what you find is that if we're in the money, we're receiving collateral, receiving cash or treasuries, which means that the risk of the sort of, in The Big Short, famously, they were worried that if they were right, they would never get paid. The industry has sort of evolved to make sure that that risk is less than it used to be.
I can vouch for that too. The collateral seems to work pretty well. And by the way, that question came from someone, I may as well say this. I've been with Ruffer since virtually the beginning, and I've recently topped up at a discount. So I think
thank you very much to whomever that is. And also, I should have said earlier, actually, we did, we're clearly disappointed about the performance year to date, but Jasmine and I, the co-managers of the investment trust, did both buy shares personally earlier this month.
Fabulous. And Okay, here's another one. Ruffer has shown the ability to react quickly to take advantage of sudden market changes and short-term pricing opportunities, topping up in gilts during the quasi-Kwarteng mini budget last year as an example. How quickly can you react to markets? But before you start, are there any sign-off and approval processes that have to take place before you can act? And how does the swiftness of the decision process extend to situations that may require a sudden shift in overall asset allocation?
So there's no sort of official sort of sign-off processes. I think we've proven in the past an ability to move pretty quickly. The Trust Kwarteng budget being a prime example. Perhaps going a little bit further back, Q1 2009. We rotated a huge amount of the portfolio. So we came into the financial crisis with 60% of the portfolio in conventional government bonds. And over the course of about 2 weeks, we sold all of them and reinvested the proceeds into inflation-linked bonds and equities. And the equities obviously being very bombed out at that stage. So we have our usual sort of schedule of meetings a couple of times a week between all the portfolio managers. But of course, as markets get more choppy, the sort of chatter on internal message boards increases, and we have ad hoc meetings as and when we need them. And there's nothing more sort of that shows conviction more than, I've started buying, I think we should talk about this. So that's sort of how it works.
So this gets back to a point at the beginning of the beginning of this, when you say we is Ruffer.
Yes. Oh, yes. So no matter which Ruffer fund you're invested in, the Ruffer strategy, the objectives are exactly the same. The asset allocation is pretty much the same, decided by the same sort of cohort of people that I mentioned earlier. The individual securities might vary a little bit, but again, not too much. And if you look at the long-term track record, if you pull them all up on your Bloomberg, over the long term, they all look pretty much the same.
And say, for example, you own 10 basis point, 0.1% in Ashmore, an emerging markets fund manager. And just take me through how that decision would have been made. Why would you own that? Who would have picked that stock?
So that stock is, so within the portfolio, some of the equities are delegated to what we call sort of sleeve managers. So Alex Grisbos, who runs Ruffer Equity in general, or one of the equity funds, like sort of value stocks, analyzed that. They've clearly been beset by outflows in the last couple of years. So he will do the sort of bottom-up fundamental analysis and allocate to that stock. How much money is given to the Alex Grisbos sleeve is a sort of decision that is made by that asset allocation committee. So today, I think it's about 3.5%.
If you thought Ashmore, let's say you personally thought Ashmore was awful,
yeah, do
you still have to put it into RICA?
No. So that there's, and I mean, not just the Duncan MacInnes thinks it's awful risk. There's also if you look at we have the Charity Assets Trust, for example, that has different requirements. So each Ruffer vehicle, although pursuing the same Ruffer strategy, might have varying restrictions, either ethical or sort of Duncan MacInnes hates Ashmore for whatever reason.
Yeah, fine. Okay, so last chance to get your questions in, and I'm now going to move the conversation as we approach the end of this to Bitcoin. One of your colleagues, Alex.
Oh, sure, Charlie. Of course, we're going to talk Bitcoin.
Yeah. Alex Charts. How do you say it? Is it Charts?
Yeah, Charters.
Charters. He wrote a very good piece in your annual review, and but when he was on some interview with Merrin, the Bloomberg thing. He spoke about Bitcoin quite negatively.
Yes.
As if conditions weren't right for it. And I had to say, although I agree with most of the things he writes and says, I was really on a different page on that particular moment. So presumably you're the Bitcoin bull in the firm. Someone like Alex back in 2020 would have been, Are you serious? Are we really putting this into the portfolio? What does Ruffer, what are the people at Ruffer, the serious people at Ruffer, what do they actually think about Bitcoin? And when's it coming to a portfolio near you?
Well, there's as with any investment, but particularly with a divisive one like Bitcoin, or Tesla is the other one that really gets people's juices flowing, is there's a range of opinions. And yeah, as you know, back in 2020, when we made the investment, I was the sort of champion of that. And I had to sort of try and convince my colleagues, and eventually we got a quorum and we did it, and it worked out well. There were some people who never liked Bitcoin. There were some people who liked Bitcoin at that particular moment in time. And I would put myself in that camp, that I loved Bitcoin. I've never been more bullish about anything in my whole life than I was on Bitcoin in 2020 and 2021. But I think the facts change, the context changes, and today I don't hold any, and we don't hold any in the fund. We haven't held any in the fund since 2021. I don't hold any personally. I mean, I still follow it, and I think the drumbeat of what is notable is that the institutional adoption and the incorporation into the broader financial system is continuing apace, even though I would say the desire for institutional adoption has waned significantly. So the infrastructure is being built for this to become fully integrated in a part of the financial system, but right now I don't think the demand is actually there. I mean, you might disagree, but I think long term that's probably pretty bullish.
Yeah.
Short term, I don't see it. And that's my personal view. If you look at, for example, the spot ETF, that's one of the big things at the moment. It looks like, based on the Ripple court case ruling a couple of weeks ago, it looks like they might actually get a spot ETF approved, which 2 years ago was one of the most bullish things that could possibly happen. But 2 years ago, Grayscale Bitcoin Trust was trading on a massive premium to NAV. So the money would have poured into the ETF. Today, Grayscale Bitcoin Trust trades on a discount to NAV. So that says to me, is there actually much demand for the ETF? I'm not sure, but that's short term. Like I said, when we talk about our inflation volatility journey, once we get through this disinflationary lurch and the stimulus comes back and the inflation returns, Bitcoin's portfolio relevance, I think, goes up a lot. Maybe.
Yeah, I mean, from what I see from certainly my travels, talking about Bitcoin and gold, it's very clear that there's a sort of institutional wall, and I think that
you mean a wall of demand, not
a wall between Bitcoin's over here and we're over here, and
all right, yes,
you're not coming over that wall or through that wall, and it's very much groupthink, and the regulators have done well to dissuade people because they kind of want more time to understand what the hell's going on in crypto. You can understand their perspective there. And I think there's a sort of, the young people in these firms are interested personally, but professionally they keep quiet. And the other ones, but there's an inevitability about the whole thing because, computers have got to transact with computers. We need to have a current account that Coots can't close. And all of these things point to this concept of digital cash, or digital assets, and the interaction of computers with other computers. And you just cannot get one traditional bank account, and people think that's digital money. It really isn't. To talk to another one, with computers, buying and selling data from one another. You can imagine this world in the future. I think most people can't imagine, but it's.
I think there's two things I would say to that. So first of all, if you remember, when Elon Musk announced that Tesla had bought Bitcoin and he had bought Bitcoin personally, which was a couple of months after we had done it, the tweet in which he announced it was, in the end, it was inevitable. That was all he said. In the end, it was inevitable. And I think I have some sympathy with that view. But of course, because something is inevitable on a 10 or 20 year horizon doesn't mean it's necessarily investable today. And it doesn't tell you anything about what the price should be today. So that's one element. And then the second element, which I think has really scared off TradFi in the crypto lingo, although the ETF may fix all of this, is that we had this theory of Gresham's law in reverse, which I think I've maybe said to you in the past. So Gresham's law is that bad money forces out good. If you know there's counterfeit money in the system, then you cling on to the money that you have because you know it's real and it's bad for velocity. So Gresham's law in reverse is that good money forces out bad. And this is what we thought was going to happen in crypto. We thought your Goldman Sachs, your Morgan Stanley, your Fidelities, all these big institutions that were coming into crypto We're going to clear it up, solve a lot of the sort of shady characters and criminality, and drag Bitcoin into the light. That was definitely my thesis 2 years ago. And then you look at what actually happened. The good money came in and it backed FTX, the shadiest character of all. And the, well, actually maybe not the shadiest character, because Binance and Tether are still going. So I do sort of, I worry that the traditional finance money is burned by that experience. You know, that they thought they had the good guy, but actually he was a bad guy, and maybe there's no good guys. I don't think that's true, but in the short term, I think that's maybe how they feel.
Well, that's the perception, and it's very easy, as we've seen again from the Coots episode, this sort of desire for institutions to look like they're on the left in so many ways, when of course they're not. They're trying to make as much money as they possibly can, and so it's a strange old thing. But I definitely think Bitcoin has got that 1971 moment yet to come. I mean, if Ruffer was around in the 60s, would it have owned gold before 1971? Well, I shouldn't think that many firms did, but Ruffer would probably claim to be one of the firms that would have done had it been there. And,
well, I think we've owned gold in various sizes every day since the firm began, but that only goes back to 1994. So can't say further back than that.
Fine, well, that's not a bad innings. Anyway, look, Duncan, thank you very much. I mean, is there any final thoughts that you haven't had the chance to say that you'd like to?
I suppose, I mean, it wouldn't be Ruffer without ending on a sort of bearish note. I mean, a couple of things. So I think, why do we think that a recession is coming? I think it's quite possible that in a few months' time, or a few quarters' time, we'll look back and say, do you know what? It was actually, it was relatively obvious that a recession was coming because the signs were there. Yield curves massively inverted around the world, 500 basis points worth of hiking with the long and variable lags of that still working through. Central banks willing to accept a recession, personal savings rate collapsing in the US, the savings and loan officer survey showing really tightening willingness and ability to lend in the US, bank failures, deposit flight, cracks starting to appear in the US labor market, although it's undeniably still very strong. Inventory to sales ratio at 25-year high. So companies, will be ordering less going forward, and general measures of economic activity like PMI, new orders, and so on, all trending down. So this will not be shocking if it happens, and yet stock markets in particular, not commodities, not other assets, are blithely ignoring these risks, and we'll see. And I just think for the first time in a long time, you get paid 5% to take no risk whatsoever, and that's a really profound change in the investing landscape. And this is about, if people can survive with 5, 6, 7% returns, then maybe you don't need to own any equities at all, and that's totally different from the last 15 years. So that adjustment of people's portfolios, as everyone tries to move down the risk curve from the risky stuff that you were forced to own for the last decade because rates were zero, towards lower risk stuff that you can now comfortably own and sleep well at night. I don't think that's really happened yet. And as that happens, everyone's a seller up here. Who's the buyer? I think the buyer is people like us, but at much lower prices.
Yeah. On that note, it's this idea that interest rates would have to stay higher for longer, and then more and more people would change their views, wouldn't they? I guess you could be arguing, what markets could be telling us that actually no one really believes it's going to last. Rates are coming straight back down again, just like they did in 2020.
Yeah, and that's why the yield curve's inverted. I think that's absolutely right. We all have become incredibly cynical in the last 50 years. We all think that the first hint of trouble, rates are going to be cut to zero, and I don't think that's going to happen.
Sure. Can't disagree. My final question, if that's true, then you've got a low risk portfolio already. Why spend so much on protection? Why not just turn that bill down?
Yeah, I think that is a valid criticism. We're trying to make money. You know, we're trying to make money. So in an ideal world, we will make money, we'll preserve capital, but also make money out of the crises like we did in 2022 or 2020 or 2008. And that's how you end up with a really spectacular long-term track record. You make money in the crises and then you hopefully buy bombed out assets on the other side. This year so far, and again, my apologies, we've sort of got that slightly wrong, but hopefully this is like post-match analysis at halftime, and at full time the score will be different.
There's never full time in finance.
Well, that is true. Yeah, I meant the end of the calendar year. Then hopefully it will be different.
Duncan, thank you very much.
Thank you.
Thank you, ladies and gentlemen, for listening. Bye bye.